What's up, ladies and gents? Welcome to another video on our YouTube channel. Today we will be looking at and trying to understand draws on liquidity and how we can react to the market when it reaches our draws on liquidity to possibly find probable entries as per our bias or predetermined direction. First, we have to understand what draws on liquidity actually is, or we will look into buy-side liquidity, sell-side liquidity, and fair value gaps. Buy-side liquidity refers to sell stops that may be resting above previous highs and or relative equal highs. Now, above every high that the market has made, there will be sell stops. These are the levels where retail traders may be thinking the market would come and create or make double tops, or there will be some form of a resistance. Retail traders will be thinking that the market would come and reject and sell from that particular level, but the market would simply buy through the previous highs and run through the sell stops that will be resting above. So above this high there will be sell stops, above this high there will be sell stops, above this high there will be sell stops. Now when it comes to relative equal highs, the market would create highs that are relatively equal, meaning the highs will be more or less on the same level. Now retail traders will think that the market has now created a strong resistance where the market would come and reaches for possibly a third time and sell from it, but the market will simply buy through the particular highs and run through the sell stops that are resting above. We also have sell-side liquidity, which refers to buy stops that may be resting up below previous old lows and or relative equal lows. Now below every low that the market has created, there will be buy stops. These are the levels where the retail traders will be thinking the market would come and create a either double bottom, or there will be some form of a support where the retail traders will be thinking the market would come and retest and or possibly buy from it, but the market would simply buy through the previous highs and run through the buy stops that would be resting below. When it comes to relative equal lows, the market would create lows that will be more or less on the same level, where the retail traders will be thinking that the market has created a strong support where they think the market would come and reaches for possibly a third time and then buy from there, but the market will simply run through the equal lows and run through the buy stops that are resting below. Now we also have fair value gaps. We have two types of fair value gaps. We have a bullish fair value gap, which refers to an institutional order flow pattern that is based on a 3-candle formation typically found after the market has run into sell-side liquidity. Now the market would run into sell-side liquidity which would be a previous low or relatively equal lows on the left. Now after running through the sell-side liquidity, the market would have 3 candlesticks, right? This would be in this illustration, this will be our first candlestick, this will be our second candlestick, and this will be our third candlestick. Now between the high of the first candlestick's wick and the low of the third candlestick's wick, there might be a gap. Now if you do find the gap, this would be referred to as a fair value gap. This is where we would anticipate the market to come into that particular level and then buy from it. Alright, so we also have a bearish fair value gap, which refers to an institutional order flow pattern that is based on a 3-candle formation that is typically found after the market has run into buy-side liquidity. The buy-side liquidity would be or might be previous highs or relatively equal highs on the left. Now when the market trades into the buy-side liquidity, we will look at 3 candlesticks, right? So this would, in this illustration, this would be our first candlestick, this would be our second candlestick, and this would be our third candlestick. Now between the low of the first candlestick's wick and the high of the third candlestick's wick, if there is a gap between those two particular levels, that gap would then be referred to as a fair value gap. Alright, so now that we have gone through some illustrations, let us go through some chart examples on AUD on the daily time frame. Right, assuming that this would be our current market price, the first thing that we have to determine is our draws on liquidity. Now firstly, we can see that this low and these two lows are relatively equal, so we would annotate those as our sell-side liquidity. Sell-side liquidity. We also have this low down here, which is a sell-side liquidity. Right, now up here we have a fair value gap. The low of this candle and the high of this candle do not converge, so therefore we have a gap in between. We would annotate that as a fair value gap. And also we have this fair value gap down here. Right, also have this fair value gap down here. Now what we want to see is if the market would trade up to this fair value gap, we'd want to see the market come and reverse to then sell to the downside, right? To then sell to the downside. So if we let the market play, we can see that the market has traded into the fair value gap. What we want to see is the market sell from there, right? If we let it play on, we can see the market has been rejecting that fair value gap for more than a week, and then ultimately it sold and traded through this sell-side liquidity level. And what we want to see now is whether or not it'll reject anywhere from here to sell into this sell-side liquidity. Right, let us see what happens. Our bias is still bearish. Right, so now we see that the market has traded into or through the sell-side liquidity. Now what we want to see is whether or not it'll reverse from those particular levels. Now what we have here is a fair value gap. Right, we have a fair value gap. What we would anticipate is the market, if the market trades into this fair value gap, we would want the market to sell, right? Or if it doesn't sell, we would want to see the market come and break this previous high to then come and retest on any draw on liquidity that it has left inside this price leg, right? We'd want to see whether the market would come and retest to then buy from whatever drawn liquidity that we have inside the price leg. Right, if we let it play on, the market traded through the fair value gap. So what we anticipate now is that the market would come and give us a market structure shift over here. Market structure shift. This is our draw on liquidity now that the market has traded through the fair value gap. The market trades through and gives us a market structure shift. Now that we have a market structure shift, what we want to determine is whether or not we have a draw on liquidity inside this price leg, right? Now if we look closely between this candlestick, and this candlestick, we can see that the high of this candlestick, including its wick, that is, right, if we can just, the high of this candlestick and the low of this candlestick do not converge, right? They do not touch at any point, so therefore this means that we have a fair value gap down here. It doesn't really matter if whether or not the fair value gap is huge or small. What matters is that we have a gap between this candlestick and this candlestick. Therefore we have a fair value gap which we anticipate that the market would trade into and then reverse to then buy from this particular level, right? if we let the market play out, alright, now the market has reached our fair value gap. What we want to see is whether or not Tuesday, Wednesday, Monday would give us a low of the week. Right, so what do we have? We have Thursday, Friday, this is Monday, now this is Tuesday. If we take a look at this, we have relative equal lows down here. So since we have these relative equal lows, we will annotate them as our sell-side liquidity. What we want to see is the market break this or trade through these sell-side liquidity and then buy from there, right? And our drawn liquidity would be this previous high. This would be our buy-side liquidity. These relative equal highs over here are buy-side liquidity, and this particular fair value gap over here. Right, we'd want to see whether the market would reach this level, and this level. Let it play out. The market shot to the upside, right? As you can see, shot to the upside. Now over here we can see that the market is traded into our fair value gap and it rejected from it, right? So what we want to see from here is whether or not the market would then sell, right? So this will be a Friday. Now using the weekly profiles, we'd want to see either Monday, Tuesday, or Wednesday give us the high of the week, right? And our draw on liquidity from here would be this fair value gap down here. Let me just highlight it. This fair value gap over here. You could ask yourself, why are we not using this fair value gap? I mean, that is because at this point, from this low up to this high, we can see that the market was in a premium. Therefore, that means it was above the 50% level between of this price leg, right? So what we'd be looking for is the draws on liquidity below the 50% level, which would be this fair value gap and this auto block down here, right? This auto block down here. So what we want to see is the market from here selling up until this level and this level, and ultimately we'd want to see it trade below this level, which is also liquidity, the previous low. So if we let it play on, we can see that Tuesday gave us a higher high as compared to Monday, right? So what we want to see is whether Tuesday or the following day, which is Wednesday, would give us the high of the week, and go into the lower time frames to find our entries, right? Wednesday gave us a lower high compared to Tuesday, therefore Tuesday gave us a Tuesday high of the week weekly profile, right? Our target would be here and ultimately this auto block down here. So what we see, the market traded into this auto block, right? When it traded into this auto block, if we would anticipate the market to reverse from this auto block, we would have our draws on liquidity on this level, which is our fair value gap, right? Our first fair value gap. And because we have these relative equal highs up here, we would anticipate that the market would possibly come and reach or reverse from these levels, right? From these levels up here, because we have relative equal highs. let it play on. Our first target, remember, was this fair value gap, and now the market on a Thursday reached the buy side liquidity, the draws on liquidity, and then reverse from there, right? So because this is a reversal candlestick now, we can anticipate that the market would now reach this level down here, right? The previous daily low. Let me just remove the OB so that we can have a clearer chart. Alright, let me remove those. Let me also remove the fair value gap. Right, so the market rejected from here after trading through the buy side liquidity, and now our target would be this low, right, which is our sell side liquidity, this low, and ultimately this low, also these relative equal lows down here. So if we let the market play on, right, so we can see that today, which is a Friday, the market traded through this sell side liquidity, right, through the sell side liquidity. Now we are done with the replay bar 2. Now we are on the current market price. So let me just go down to the hourly time frame to see whether or not we could have anticipated the move to the to this sell side liquidity. Whoa, so from here we have this fair value gap, which the market traded into and then sold during the Asian session. When the London open session came into play, we can see this is where the market was currently at. And what do we have on our time frame? We have this fair value gap down here, right? Because we are anticipating that the market would eventually reach the sell side liquidity. If we go to the 15-minute time frame, we can see that the market traded into the fair value gap, right? This was when the London open kill zone came into play. If we go to the 5-minute time frame, what we see, what do we have? The market traded into that fair value gap, right? It left fair value gap over here and also this fair value gap down here. We had this fair value gap down here also, so the market traded into the fair value gap. If you had entered down here, then this would have been, you would have placed your stop loss above this level, above that candlestick, and your target would have been this level, which would have given you a 1:2.3 reward, right? So ladies and gentlemen, this is our video for today. If you like the video, please like and subscribe. If you have any comments, if you have any questions, just please comment down below and we would reply, of course. See you on the next video. Cheers.